What's up everyone, Tom here with another video. Today we'll be talking about our live trading technical analysis, where we go through price action based methods and talk about the live results as well as ways of potentially looking at the trade a little bit differently. In this episode we'll be covering how to reload your trades and also some good positioning in terms of stop losses along with the trend. If that's something that interests you, stay tuned. So many people ask me, how do we enter positions and how do we find key zones? Well, we've talked about how previous resistance becomes support several times on this channel. And this is where we have a key level of resistance, such as this 114.55 on the Swiss yen, and that then acts as a level of support if it's ever closed above, like it was here, and then retested during the conservative entry. So a few things just quickly. If you're a stock trader, a commodities trader, or a currency trader, these same price action methods will apply. You can use them in any market, so definitely don't tune out just because it isn't a stock or whatever you trade. It will work on every single kind of process. So here we have the resistances. That then becomes a great support level. And because of the number of touches, and also when we zoom out and we look at this key zone over time, we know that when the market has closed above this zone, clearly something has happened dynamically in this trade. The Swiss yen wants to move higher. It was moving higher coming into this, and that this resistance, which has broken now, signals that the market wants to go to the next level. So what I like to do is I like to count how many times it's touched, and we'll just go with the most recent ones because this will be enough. So it's got 1, 2, 3 touches, closes above, and that's enough for me to be then looking at potentially entering the position when it comes back down to the 114 kind of 55 area. This really is a very nice trade, but you've also got to think about, what am I expecting from this trade? So the market will often move up and it will hit the previous resistance. But because of the nature of this big break coming into it, I believe there's more in this trade. And in terms of the analysis, there was at least up to 117, 118 over the long term. So let's see how the market plays out with this zone. And this was definitely a zone where I bought it around this 114.60 area, and I'll be showing that a little bit later. So the market comes down and actually breaks through it. Now, a lot of traders will be concerned with that. And ways you can deal with this is either you want to have a larger stop loss underneath the last swing, or you want to wait for the market to turn in your direction of trend and make a lightning bolt effect, where effectively we have a trough, we have a peak, we have a higher trough, and then a higher peak. Once that forms and we get that lightning bolt effect, it says that the market is ready to go to the next direction. So what happens here is the market goes down to the trough, it goes up to a peak, it makes a higher trough, and then it tries to make a new lower low kind of point and then breaks up. So what I did with this trade is I took it around this 114.60 area, and I was happy with that trade, and I was happy with this stop loss holding the area. So what I did was I moved the stop loss down to this zone, slightly underneath, actually underneath these wicks. So did I set the take profit up here at the high like a lot of people would? I expected more from this trade. So what I was trying to do is, because I expected it to go up to this 118 area, I wanted to then see if there were places that we could reload, and I wanted to move my stop loss up gradually throughout the process. So some of the ways I do that is when we break this previous peak, we know that firstly, this stop loss is holding very well. This is a very good stop loss. It becomes, instead of being the kind of more aggressive stop loss, it becomes the conservative area as we've broken above. We can also note a few things here, that the 20 moving average held it 2 times. So when I saw this bullish hammer coming off this particular 20, I entered a second position because I was happy with the higher peak, I was happy with the direction, and more importantly, I was happy with how key this zone is. So this meant that I was taking double the risk, and I added a smaller order on the way towards, of course, the profit zone. Now, where do I place the stop loss for that? I place the stop loss for the second one behind this hammer, and I do this because this is the type of candle that I expect for it to be very bullish. You can then see the market respects the 20 again, giving us another area where we could be looking at entries, and it makes a higher peak again. And what does this signify? It signifies that we can move the initial stop loss behind the last swing as well. So that then becomes the area where all of our stop losses are being held. The market then comes down to the 20 again because of the signaling effect of how the 20's been holding. I take another position at this point and I take that long. And again, I place my stop losses all under this position here with the idea of this trade moving higher up. And that is my hope for the trade. Now the trade goes back down and goes underneath the 50. We're still holding the position and we're still absolutely in the trade at this stage. But what does happen at this point is things change from a perspective of where we're at in the market. So I want to talk about that. Did I take this extra position? I certainly did. Did I take that initial kind of entry position over here and this position? Yes. But then we have an event, and that event is the non-farm payrolls. So effectively we're going into the weekend and we're going into a very important time. So when I took that particular last order here, it was on the 6th of August. Do I think there's more in the trade? I absolutely do. But it didn't move that quickly, and I don't like to necessarily take these types of trades with multiple entries into non-farm payrolls. So just before non-farm payrolls in the afternoon for us in Australia, I chose to close the order and therefore close all of the positions and all of the profit. Now, is that the right move? Well, I always see it from this perspective. After non-farm payrolls happens, I can then wait the weekend, eliminate that risk, and then come back in on Monday and look to see whether there's any opportunities. We'll also notice that the market was not holding the 20 on the last time. So although the 20 reload zone worked very well for us the first time over here and would have worked well on the second and potentially would have worked well on the third, non-farm payrolls ruined that particular opportunity. So we ended up with a nice healthy profit here, getting in initially here, getting a second entrance here, and then moving our stop loss behind, and then of course a small loss on the last entrance. And if it wasn't for non-farm payrolls, we probably would have held even longer through the weekend and continued with the trade up to the levels that we originally hoped. In this case, it's one that we can revisit in the future if we choose to pick this trade back up in the next week. So that of course was a winning trade, but what about losing trades? Many people always want to know, well, what happens in a losing trade? Can you avoid losing trades? Well, one thing we'll notice about that Swiss yen is it was in the direction of the overlying trend. That was the 4-hour chart. Here is the US dollar CAD, and it's another one that I took in the markets, and I'll explain a few reasons why, and why I'd probably take it again as well. So here we have a nice base, and I think a lot of people will see this as a little bit of a double bottom on the smaller time frames. We're clearly in a downtrend, and this really signals, should we be taking longs? We probably should not. We should be going with the trend and shorting it. And I really bring this one in because I'm experienced in the markets. I've done this for a while, and therefore I'm happy to take these trades, but I know that there'll be lower statistics. Firstly, I've got this big horizontal resistance line here because it was previous support. And actually my main goal here was if it went back to the 135 psychological support line, that would act as resistance, and I'd be looking for a lightning bolt down here. That would have been the ideal trade. But I noticed this particular hammer rejection coming off, and there was a clear level of resistance bodies coming through this zone. So I was interested in this level. I was interested in this kind of 134.40 zone. Now, just after that hammer happens, a second one occurs. And what I do is I make the decision here that if I see this wick get taken out, I'm going to enter the position regardless of where the close is. How come I make that decision? Well, because I know that the profit can only be up to this 134 kind of 135 area. And I want to take it slightly earlier than this. So for me to make my reward risk kind of situation work out, I need to have a small stop loss underneath these wicks. And I also need to have the idea that I'm not going to get that much profit out of it. I can't be trading this very long all the way to the 200. It's just not going to work out a high statistical amount of the time. So then the market does move up. And what ends up happening is the market effectively wicks the position out. And you'll notice there it is. There's the wick, and there's no body close above. Pretty much after I didn't see a body close above, I knew that I was probably doomed on this trade, but I'm still going to hold the position long because that was what I wanted to. Some people will say, could you have waited for a body close up here? And I definitely know that this will be a higher kind of chance of entry if we wait for a body close up here, wait for it to move up, come back down, and then go up. But I was sufficiently happy with the price action that we saw with these two bullish hammers after each other, and the idea that the market had wicked higher and therefore pulled my pending order. I also was not going to be in front of the charts for this period of time, so I thought best to put the pending in. But it's a word of caution for many people. Firstly, what were we doing? We were counter trending. Secondly, I was taking a position before we saw confirmation close. So are there things that I could learn out of this trade? I don't really think so, because I'd be happy to take it again. But it's a very specific scenario with a very specific set of parameters. And usually for any beginner trader, you do not want to be counter trending against the bigger trends whenever possible. If you had shorted throughout this whole market, and if you look at the CAD right now, you'll notice it continues to short. That is because that is the trend right now. And following the trend, you know what they say? The trend is your friend. So the last position I want to look at is this Euro Yen. And the reason I want to look at this is very similar to that Swiss Yen. Both yens, both in the direction of up. So we know this is coming in with a series of higher highs and higher lows and a nice amount of structure coming into the 124 area. That's awesome because structure is key because it shows that the market has thought about this level, it's found resistance, and then it potentially could be looking for a breakout. So initially, what's the plan? The plan is that it closes above, comes back down, touches this level, and then buys off that level. So let's play out what ended up happening with this zone. Effectively, what happens is the market does close above, which we're about to see. Notice how there's a bit of a fake kind of rejection here. If we look at this candle looks like it's a shooting star. It unfortunately traps many traders there. And then we see a big confirmation candle followed by a nice big move. Now we're expecting a lot from this trade in terms of move up. So at this point, what we're doing is, let's say we've missed this trade, we're looking for re-entries down at the 124. Another thing that we can do is that we've seen the 20 moving averages here. So this is going to be a strong enough point for us to probably put a pending order long at around this 124. And that is what I did with this particular trade. Obviously, this is a trading account that I want to make more realistic to everybody out there that's looking at trading, because if you're risking around $500 to $750 per trade, that is potentially something that I think many people can move on. But it doesn't matter, again, if you're $100, $200, or $50. So what happens here? The market does its normal thing where it starts to sell off and it comes down to the 124 and then strongly rejects that level. When it strongly rejects that level, you're pretty sure that you're going to be in for success, because not only did it respect the level, there was clearly buyers there. Where do we put the stop loss initially? We want to put the stop loss underneath the last swing. So the 123 kind of 25 or 122.92 are both good levels for this particular zone. When we continue to see it move up, we want to see it make a new high where it closes above this 125 zone, and that's going to signify a lot of strength. But what do we know about this week? We know we're going into non-farm payrolls. So we continue to see strength going into the 7th of August, and effectively at that point we have to make a decision. Do we want to take this trade into non-farm payrolls or not? Now, I elected to not take it into non-farm payrolls, and similar to the Swiss yen, I chose to close the position early. It still allows me to come back in the week after and potentially look at taking other trades. But hopefully that does make sense. There are some key bits of news that you may not want to take your trades into, and you're always got another opportunity to get back into the trend later on. If this video has helped you today, please make sure to subscribe and of course hit that bell, and I hope that everyone's learned something out of this one. Remember, price action is key, and when you're following trades like this one here, notice again that the 20 moving average acted as a great buy zone along with the trend. So each one of these 20 moving average zones could have been a buying opportunity within the trend based on your larger term analysis. We'll see you in the next video. And thanks very much, everybody. The trading community is certainly great. Bye for now.